Let's start with the fixed income side of the market. Weighted average yield on 2-year government bonds jumping to over 22% at the auction yesterday. That's a 6% increase from what we saw at the last auction. Just take us through the sale yesterday and what you're reading into these surging yields.
If you look at market weighted average, it was actually at 23%. It's just that the central bank had to discount it so that at least they contract that debt a bit cheaper. And you see, the subscription was about 10.7 B against the 9.9 that they took in, which means it shows also the government is thirsty for money. And what we are seeing is a situation whereby government will continue issuing shorter-term debt, and the market is also willing to participate actively in short-term debt, especially now that people are anticipating the plateau phase of the interest rates.
As you say, the government are thirsty for debt and thirsty for money at this point in time. Not debt, rather money, but prepared to offer paper at these high yields. Can the government sustain paying interest on yields at these levels?
Well, it's not sustainable in the long term, and that's why I mentioned that they'll only issue short-term, probably just up to 2-year paper, even in subsequent primary issues, because they're cognizant of the fact that the current rates are not sustainable, and that's why you won't see 10-year, 15-year papers coming in at these levels. But the fact that the government still has to continue with its operations and they still need to raise money, so they'll have to issue the debt at these levels.
Let's move on to the equity market. NIC Bank slipped back yesterday, but that's, of course, before results were released. A 29% increase there in pre-tax profit for the third quarter. 2.6 billion shillings was made. What is your take on the numbers and this bank, which is, of course, operating in the mid-tier space?
Well, 29%, a bit lower than its peers, but what is important is still a double-digit growth. But what we are seeing is that the banks are starting to slow down in terms of their reporting, the earnings, the kind of earnings they're recording. And we're not seeing much difference between what they're reporting at this time, third quarter, and the full year results. And for a bank like NIC, it's the same way they mentioned that they'll be looking into the region just to diversify its income streams, to operate in different macroeconomic environments, just to solidify its growth momentum.
So as you say, diversifying its income streams. Standard Chartered Bank came out with results after the close of trade yesterday. Pre-tax profit down 11% to 5.5 billion shillings for the first 9 months, really hit by losses in its loan portfolio. We saw that for other banks like National Bank of Kenya. Disappointing that it wasn't able to really gain from the rise in lending over the period.
Yes, I mean, banks are really taking a hit, especially on the loan book, because as the economy slows down, then the uptake of loans also diminishes. And that's when now your bad book starts expanding, because loan quality deteriorates. And you see, for, say, consumer lending, for an individual, they're prioritizing their expenses between, say, meeting their day-to-day needs and the servicing a loan. Of course, they'd rather put food on the table than servicing the loan. The bank ends up with the poor quality loans. But of course, they're also getting a hit from interest income, and having a large portfolio of government securities, that also affects them. And you saw that the expenses rose by about up to 5 times the growth of their income. So that also took a hit.
What's driving those operating expenses?
Well, what's driving operating expenses mainly in terms of HR costs as they expand to introduce new products. There are also IT costs. There are also Standard Chartered has not been as aggressive in terms of branch expansion. but they've recently moved into a new building, so they're also incurring some increased admin costs on that.
In 2009, Standard Chartered was the second most profitable bank. It's now slipped to the fifth most profitable bank. What are they getting wrong in terms of strategy, or what are the other banks getting so right at this point?
What the other banks are getting right is they're just becoming more aggressive in the market. The likes of Equity, Family Bank, the banks that have been coming up. Standrad's main undoing is that it has been very conservative in the market, and as you see, the Standard Barclays is also in that the same group where their earnings are slowing down while their competitors are slowly catching up with them. So they really need to open up and relook at how they want to operate in this environment.
Family Bank, as you mentioned Family Bank there, they're delaying their listing on the NSE to next year. It's not surprising given the bear run in the market. Is this likely to be a trend that we're seeing for listed companies delaying that? And what does this mean for the deepening of the capital market in Kenya?
Well, they had to put it on hold because current market valuations are not very attractive. And for Family Bank, they're looking at adding a premium to their intrinsic value of the share. So the current valuations in the market are not attractive, and by experience, looking at previous listings, Trans-Century, British American, which experienced a 40% decline in their listing price. So Family Bank is aware of that, and they're willing to put it on hold. And also considering that it wasn't an IPO where they're looking to raise money, so they are not at pains to put that on hold.